we are in this earnings season. About 139 companies, or just over a quarter of the companies in the S&P 500, have reported first quarter results. Overall earnings for the index, they're expected to fall about 5.2%. That's according to Evercore ISI. So let's get a take on the earnings season and what investors should be doing now that we know what we know. Joining us now to discuss is Kleo Curry, UBS Wealth Management Vice President. Kleo, thanks for being here. Now, companies are coming out and beating estimates, as they tend to do, but we are still seeing that negative trend overall for earnings. What's your take thus far in the earnings season, and how are you sort of forming your strategy around it?
Well, good morning, Julie. And to your point with regards to the earnings season reportings, results are coming in stronger than anticipated, to the extent that they were coming in last week. But what we're seeing priced in the results this week is that they're coming in a little bit more in line with what we were expecting, which is softer return, softer earnings reporting. And so with that in mind, I would encourage investors to look to the defensive sectors within the U.S. equity space.
And what does defensive mean to you, Kleo? I feel like it's sort of in the eye of the beholder, and it also changes over time as different sectors sort of get defensive at different times in the economic cycle.
Sure. So that's a very good question. And defensive are consumer staples, industrials, utilities. These are companies that are going to benefit from and be relatively insulated from slower growth. And also is particularly on the utility standpoint, companies that will benefit from the infrastructure spending that's set to play out.
Interesting. On the flip side of that is mega cap tech, which we're starting to talk about today, of course, with Microsoft and Alphabet, and then we'll be following Meta and Amazon as the week goes on. We have seen such an outperformance by those stocks and such a weighting of those stocks in the rally that we've seen thus far this year. Is that an area that you think investors should be staying away from right now?
I'd be cautious on tech. Tech certainly had a run-up in the markets at the start of this year, but that was likely due to the tech markets pricing in a soft landing versus a hard landing or recession. So it's not pricing in those factors. Another reason to be cautious on the tech space is that their earnings are still
And Kleo, we've also had a lot of discussions with various strategists on the show about what they're recommending for sort of equity cash or equity fixed income balances, because oddly enough, fixed income has been like the new hotness this year because everybody's attracted by the yields. How are you thinking about that as we head into the second half of the year and maybe or probably a pause from the Fed?
Sure. So what I found with working with my clients is that cash and also high quality bonds have been somewhat of a flight to safety. They've worked out well. Yields have been quite attractive on the short end and within the liquid space. But one thing that I would caution investors to keep in mind is that at a certain point, the Fed will stop hiking, they will pause, and rates will start to come down, and they could come down quickly. So I think it's a good opportunity for investors to start considering some duration priced into their bonds so that when rates do start to pull back, they're already taking advantage of some of the rates within the fixed income space on the longer duration side.
Interesting. Good thing to keep an eye on. Kleo, thank you so much. Kleo Curry, UBS Wealth Management Vice President. Appreciate it.